Hi, and welcome to the CU 2.0 podcast with big new ideas about credit unions and conversations about innovative technology with credit union and fintech leaders. This podcast is brought to you by Quillo, the real-time loan syndication network for credit unions, and by your host, longtime credit union and financial technology journalist Robert McGarvey. And now, the CU 2.0 podcast with Robert McGarvey.
What do you know about Gen Z? What exactly do you know? That just may be the critical question confronting credit unions today, and that's because at ages 13 to 29, Gen Z is increasingly the focus of fintechs, neobanks, and non-banks who all want to grab these consumers. How can credit unions win in this battle? On the show is Lee Wetherington, Senior Director of Corporate Strategy at Jack Henry. And lately, he's been thinking in depth about Gen Z because the generation has entered a prime spending age. Wetherington believes that credit unions, in fact, have pathways to getting Gen Z as members. He offers a concrete strategy for doing exactly that. He acknowledges this is going to be a tough fight. The competitors are well-funded and focused, but he expresses optimism about the ability of credit unions to win. Along the way, Wetherington also offers insights into how credit unions can win at AI and how recent developments in crypto banking may turn out to be for the benefit of credit unions. Listen up. You're gonna tell me about Gen Z and why they're using credit unions or not.
Yeah,
I'm not terribly interested in Gen Alpha unless you can convince me I should be. I mean, I think these are still kids with piggy banks or something. But, perhaps I'm wrong.
I think we should concentrate on Gen Z for the reason that Gen Z is the biggest shaper and driver of financial services in a three to 5 year frame. Gen Alpha is right behind them. They have some similarities, but yeah, we should concentrate on Gen Z. I think the bigger issue is, and you mentioned this the last time we spoke, hey, this sounds a lot like the conversation we had about Gen Y. And, credit unions and just financial institutions in general didn't make a whole lot of progress in understanding how to recruit, attract, retain sort of always the next perpetual generation, whatever the specific identity of that generation is. But for the moment, Gen Z is where all the action is and where we should concentrate. And credit unions really need to understand what's unique about their behavior generally, but their financial behavior and expectations specifically, because these are knowns. These are things that you can know. So yeah, I'm ready.
The oldest Gen Z is now approaching 30, if I remember my numbers right.
Yeah.
And that means they're at a point where they're thinking about possibly buying a house or not. They certainly have thought about and maybe have already bought a new car. These are people who are beginning to spend some serious money.
Yes.
Whereas the people in my age group are thinking about how do I not spend money?
Right. Yeah, you're conserving, right? You're trying to make sure what you've got's going to last. Yeah,
exactly. I remember being that age, and it's a fun age because suddenly almost anything seems possible if you have a decent job.
Right, which is a very big asterisk right now for a lot of folks. I have two boys that are Gen Z, and they're relatively new to the labor market. Fortunately for them, they've both found places to land, but a lot of their cohort, their friends, are struggling to find that first toehold. And we could go in a lot of different directions there, but you're right. So that upper end of the Gen Z demographic is closing in on age 30. And by the way, just for reference, like somewhere between ages like 15 or so to about 27, historically speaking, that age window is the window in which a consumer typically chooses their durable primary financial service provider. So that also brings up the question of, well, how does Gen Z think about what qualifies as a primary financial service provider? And their thinking on that is a lot different than my generation, Gen X, and older generations for sure. The way they think about that, or at least the way it's different, I should focus on is one, a lot of them think, the first app that does something with money for me is my primary financial service provider. So for many of them, that's Venmo or Cash App or, maybe PayPal, others Chime, et cetera. And so they think, well, that's my credit union or that's my bank more often than not. And so I'm just going to look to that entity, to give me what I need. Now, as they begin to grow, as they do get that job, as they have money to spend, and over time, as their financial needs get more complex, they start realizing that, hey, I don't have everything I really need necessarily in this Venmo app, and I want to borrow money for that car, I want to borrow money for that house, et cetera, et cetera, and then they start broadening sort of their lens on where to go for what they really need. But the point being here is that Gen Z is still in play now. That for capturing them as if you're a credit union wanting to become their primary financial service provider. But the trick is you've got to get them to the door, which is no small thing. You got to meet them where they're at, which is to say on TikTok and the socials, they want to see a face. They want to see someone who's being honest and authentic and isn't just there to spew commercials about various products. They want someone they can trust. This is why, the biggest financial influencers or finfluencers among Gen Z fit that bill. They're people that, do actually know about money and break otherwise complex or new financial problems or milestones down into very simple terms that Gen Z can understand. One of the biggest influencers, by the way, is someone named Vivian Tu, who goes by the brand name BFF. Your BFF. Your rich BFF. Your rich best friend forever. She's amazing. She's got 10 million followers. She does know money. So unlike a lot of the finfluencers on TikTok that might have no idea what they're talking about, and there are a lot of those, you do have a handful like Vivian who are really solid, who resonate. And by the way, Vivian just became the quote unquote chief financial empowerment officer for SoFi, which was a smart move on SoFi's part.
Oh, for SoFi, that is
SoFi, and again, SoFi really was the entity, if you go back, who perfected these go-to-market strategies targeting Henrys, right? The high earning, not rich yet crowd. And that mechanism that they perfected, and then a whole lot of other big fintechs also followed suit on over the last decade, is why we've seen so much attrition away from credit unions, community banks, and even now the mega banks. Now, right now, as we speak, mega banks and big fintechs are the two categories of financial service providers that dominate Gen Z. The segment of Gen Z that is actually doing anything meaningful with a credit union or a community bank is negligible. And in fact, as of let me give you a little taste for just how big a problem, competitively speaking, the fintech threat is for credit unions and other community financial institutions. Back in 2021, credit unions and community banks were capturing about 11% of consumer switch flow, which is a way of talking about consumers who are either new generally to banking, that is to young people, or they're switching from one financial service provider to the other. So credit unions and community banks were capturing about 11% of that back in 2021. As of the end of 2024, they were only capturing 3% of that. Over that same time frame, fintechs back in 2021 were capturing, I think, about 17% of consumer switch flow. Fast forward to today, they're capturing around 45% of consumer switch flow. The other thing to note there is that even though mega banks dominate, or have at least over the last 7 to 8 years, they've dominated ownership of the Gen Z segment, their grasp on that segment has begun to loosen over the last 3 years. There's data to back all of this up. But the question is, where are those Gen Zers who are leaving mega banks? Where are they going? They're not going to credit unions. They're not going to community banks. They're going to these big fintechs, payment apps, neobanks, non-chartered neobanks like Chime. That's where they're going. And so you're beginning to see this bubble up, by the way, in top of year survey research across credit union CEOs and other community financial institution CEOs, really waking up to just how big a problem not just this competitive threat is, but how existential the scope of that threat is in terms of deposit attrition over the last, 4 years or so, which, by the way, amounts to about $3 trillion. If you just look at from the pandemic on to where we are, $3 trillion in demand deposits have left credit unions and banks and gone into investment accounts at fintechs and to savings accounts at fintechs. And so when you think about that $3 trillion attrition, now on top of forecasts about stablecoin uptake over the next 2 to 3 years, possibly reaching into the $1 to $2 trillion displacement range in terms of deposit attrition for credit unions and banks, you put all that together, this is really serious stuff. And it's not just something that you strategically would be good to do. It's like for the survival of your credit union, you really need to dial in and understand Gen Z and what makes them tick, what they want, how to get them to the door and then through the door.
Let me ask a screwball question.
Love those.
I always do that. That's kind of my specialty. Is this change an existential threat to Jack Henry? In other words, do you have products that fintechs would be interested in on a large scale?
Well, first of all, I guess to answer your question, anything that is an existential threat to community financial institutions is a threat to us.
I mean, there's a motto, which is that
we have a shared.
If the host animal dies, the parasite dies.
Well,
and I'm not trying to say you're a parasite.
Thank you for comparing us to a parasite. It's a great.
Well, but it's a law of biology.
No. This is absolutely right, because we actually do functionally operate on a shared fate model with our community financial institutions, and we are, singularly focused on community financial institutions in the United States. I
don't think these big fintechs need a core system. Maybe they do.
Well, okay, well, that's an interesting conversation. And by the way, a lot of fintechs, in fact, a whole new cohort of fintechs are lining up at the OCC and some with the State Department of Banking in Utah to secure charters to become banks, to become national trust banks in terms of the OCC. Some, like Erebor, a full service national bank. PayPal has put its lot in Utah for an industrial loan charter. So a lot of these entities that we usually throw into the big fintech category are actually becoming chartered financial institutions, and they actually do need core systems. They actually do need ledgers that scale. They do need all of the integrations and the compliance rigor that goes around all of that you need to be a chartered financial institution in any sense. So that's an interesting question, and I'm happy to go down that rabbit trail further if you want to, Robert, but you're bringing up a really good point. Yeah, this is absolutely a concern, not just for our clients, but also by extension for us. And so what we've been doing about this is we've been pioneering and innovating at the point where things matter for Gen Z, or can help our clients matter to Gen Z, to bring them to the door and to get them through the door. So just a couple of things there. Just a few things about Gen Z that make them different. They're not often broadly understood. One, Gen Z is psychologically anchored to wherever their money grows the fastest. What that means is wealth tech. They want to be able to have options to invest. And by the way, as a cohort, they're much more willing to invest in non-traditional asset classes, right? So that's everything from cryptocurrencies to other forms of digital assets, to private equity, even to direct investments. They're much more inclined to invest and put money into those non-traditional asset classes than are the older generations above them. Number two, so that, by the way, another way to bottom line that, this is why Robinhood is such a big deal and has been growing gangbusters, because Robinhood understands that about Gen Z, and that's everything sort of, Robinhood cut its teeth on, was democratizing availability and access for, average young people to be able to invest, fractional share investing, et cetera. That is absolutely necessary if you're going to want to attract and serve Gen Z, is to give them some sort of vehicle for investments that is easy and seamless and a part of your digital UX or mobile app for Gen Z. The other thing that a lot of folks don't really get about Gen Z is, in terms of their payment preferences, in terms of how they want to pay or get paid, they have a huge preference for debit cards and transactions on debit rails. The other way of saying that is they avoid credit cards. And they avoid credit cards because they perceive that credit cards are the easiest way for them to get into a debt loop or cycle that they can't escape. By the way, this is also why Gen Z is the biggest driver of the year-over-year growth we continue to see in buy now, pay later. They consider buy now, pay later to be also a safer option than just getting a credit card and not being able to, control impulses. So if you understand that about Gen Z, you also will begin to understand why all of these big fintechs and payment apps and neobanks like Chime, they have all issued their Gen Z clients, in fact, this is the first thing they want to do, a debit card. Because Gen Z wants to use that debit card, or they park it in a digital wallet somewhere, and that's the primary way that they pay. Now, that is also strategically important for credit unions to understand, because debit rails are how you can reverse this deposit attrition cycle with this demographic, them being able to be drawn away. In fact, you can reverse that if you're really smart in the types of payment capabilities that you make available, not to your membership generally, but to Gen Z specifically. So this is why we pioneered, in concert with a partner, Move, which is the world's only, from the ground up, sort of modern payment processor, sitting on public cloud architecture natively. We partnered with Move, Visa, and MasterCard to put together what we call rapid transfers. And rapid transfers is just basically a way for anyone at the credit union, any member, but especially Gen Z, they put in a debit card that has been issued to them by whomever, Chime, PayPal, right? Venmo, Cash App. By the way, all of those players, SoFi, all of them issue debit cards. So the trick here, and to understand strategically, is that if you give a new Gen Z member, the opportunity to put in a debit card they have at SoFi or PayPal or Venmo or Cash App, they only have to do that once, and now they can use that to basically draw funds from those third parties and bring those into the credit union. That begins, could and should conceivably begin when you get them through the door through their new account opening process. And then separate from that, you say, okay, now you have 30 days, 60 days to fund your account with the credit union. We don't assume that you have another traditional account at another credit union or bank. We know that you probably have relationships with some of these third-party fintechs. So just put the debit card that they've issued you here, and you can just fund your account that way. And by the way, from now on, you can use us, that is the credit union, to move money around all the different providers that you have relationships with. And this is another way that the credit union can achieve or accomplish what we call first app status, right? So that they become the place to go if you're wanting to use those debit rails to move money around all those different players. And this, again, the most importantly, it helps reverse that deposit attrition cycle. So again, they're anchored where their money grows fastest, which kind of commands, that you need to have some kind of, investment capabilities or a wealth tech, like a Bits of Stock or an Investify, something like that, embedded into the credit union's digital experience. You want to make sure that again, you got to do the right marketing, short form videos on TikTok where they can believe in you, see a real person, a real human being that's not just trying to sell them product, where they can trust. You get them to the door that way. But then to get them through the door, this is a known formula. To get Gen Z to actually complete a new account opening process with the credit union, it has to be mobile only. It has to be able to be done in less than 3 minutes, which is to say you cannot present them with a manual KYC challenge. They need to be able to take a picture of their driver's license and be done with it. And then you end the account opening process under 3 minutes. And you say, congratulations, you're a member of the credit union. Now we're giving you whatever time frame to fund that account. And by the way, to do that, just put in a debit card. Anybody else has issued you a debit card, just put that in here, and you can in real time bring that $100 initial deposit into the credit union. And this capability is now available to you all the time. You can put in other debit cards with other third parties, and you can use the credit union as sort of your home base for seeing all of your money and moving all of your money around as needed. If you begin putting all of these things together, Robert, where you end up is not only wanting to check all of those boxes I just mentioned, but if you begin putting things together like, hey, we have a credit card. We're going to issue you a debit card here at the credit union. And that debit card has a rewards program that rewards you in fractional shares of whatever asset you're interested in. So basically automatic rewards, fractional share investing, you tie all of that together on the debit card and the debit rail that they prefer. Now you're cooking with gas. And that is the known formula, at Chime, at Robinhood, at SoFi. And it doesn't have to be a mystery. You just have to execute on those fundamentals.
Now, when you tell a credit union CEO what you just told me, does the person throw their lunch at you? I mean, what do they do? I'm sure they throw something at you, hopefully not too hard.
Well, given most of the meetings, are over Zoom,
that's good,
Robert,
that's good.
The actual physical food doesn't reach me, even if it does make a mess on the screen. No, I don't get thrown at. And honestly, to be real, this is anecdotal, of course. I'm in a lot of conversations with credit unions and credit union CEOs and boards specifically, year in and year out. No, this doesn't sound insurmountable to them. It's like, oh, okay, so this is how we need to do account opening to make sure that Gen Z won't abandon us if we can get them to the door with the right marketing. Yes. And in fact, when you start thinking about, when I say to a credit union, hey, Gen Z really likes to see real people in short form videos, teaching them things that they don't know about money, especially people that they can actually trust. All of that seems absolutely at home and within the wheelhouse of the average credit union, right? Because that's people helping people. That's what that sounds like. And it is what it's like. It's just that most credit unions have not gotten comfortable with, meeting Gen Z where they are on the social platforms, where they're learning and deciding what to do with everything, not just their money. It's where they consume news, et cetera, et cetera. And you have to understand that. And by the way, that's why I mentioned Vivian. If you really want to get just a very quick understanding of what that looks like and how to do it, follow your rich BFF on your social platform of choice and see how Vivian does what she does. It's not a mystery. It's not a complicated formula. And more to your question, it's not alien to the credit union way of people helping people. In fact, I think it's spot on for that. They want to be talked to human. They want to be able to engage digitally with real humans and know that they're not being sold a bill of goods. It's really, really important. So these things are not foreign, and they're actually not technically complicated. Now, if you're not already offering some form of investment service or capability, even that is not a big lift for the average credit union these days. It's just a matter of looking at the different wealth tech fintechs that are out there who, have a proven track record of embedding into credit unions' digital layers. And now you have that option and availability for fractional share investing and other things that is so meaningful to Gen Z and will psychologically anchor them to the credit union. The last thing I would say is if you zoom out to the broader structural challenge of just, getting whatever the next generation is to the door and in the door. The other thing that credit unions have got to get really serious about is family banking structures. So that is basically creatively using co-managed accounts to take advantage of the way families actually operate and to reestablish generational continuity with membership. The reason why SoFi and these other big fintechs have been so disruptive to credit unions and other community financial institutions is because they disrupted what had been a literal analog generational continuity, literal hand-holding of parent to child down to the credit union to open that first, savings account. SoFi's come in and said, no, we want to target these young folks just as they're beginning to make real money, but they're not rich yet. We want to go just after them. And that completely threw a monkey wrench into the generational continuity that credit unions have relied on for the existence of credit unions to kind of refresh and continually renew their membership bases. The question now is, how do you do generational continuity in a digital context? That's family banking. So, and by the way, there are a handful of fintechs that do this really well. The one that's known is the most popular is Greenlight. Greenlight, however, while the functionality is really great, it actually will take deposits out of the credit union. The deposits actually in and around the different parent-child, for purposes of things like allowance and, learning about money between parent to child. A lot of that will actually siphon deposits out of the credit union into a separate place and institution. So what you really want to look for in a credit union are sort of family banking fintechs that you can embed into the credit union's digital solutions and UX. And it gives parents this really cool way of digitally introducing the child to money generally, but to the credit union specifically. But then on the other side of that, also have other co-managed account capabilities that are everything that my generation also needs, which is to say, how can I co-manage and take care of my elderly parent, right, who needs my help in managing their bills and that kind of thing. This is a really big issue for my generation, Generation X right now, because we've got both things going. We've got kids and we're having to begin taking more and more responsibility for our parents. So there are fintechs out there like Rego, like Nuvia, that do this kind of thing and do it well, and they do it in a way that is credit union centric, right? They're not trying to be their own thing off to the side, actually being competitive to the deposit base of the credit union. So all of these things, both structurally and then specifically around Gen Z, the Gen Z cohort right now, are known, and it's just a matter of not just knowing, but executing to get these things in place. Or if it's family banking, having that as a part of a longer term 3 to 5 year strategy so that you've got a structural answer always perpetually to this next generation challenge in the credit union.
You talk about account opening. I think many credit unions are very paranoid about synthetic identity fraud, stuff like that. Mm-hmm. So the account opening becomes, in my mind, vastly more complex than it has to be.
Right.
I think a company like Chase says, okay, we're going to have X synthetic identities in the coming year. We know what X is, and we can live with that. Life goes on. Let's just speed it up. Credit union says, wait, one is too much. Well, hey, dude, it's you're going to have one. So what they don't have much tolerance for that kind of failure, that kind of risk.
Yeah.
And I also go back, and I agree with pretty much all you're saying, but I go back to conversations I had with credit union CEOs who would tell me over and over again, look, over the long term, no one's going to trust an institution that's not federally insured. And I'd say, they don't even know what that means. What are you talking about? I'm an old guy. I have never benefited from federal insurance on my savings or checking accounts. Never.
Right.
I didn't have money at Silicon Valley Bank. I didn't. It's
right.
So who cares about this? No one knows what this means, man. But they're saying, oh, no, this is critically important. And So how do you have you not run into that? Am I just running into particularly old-fashioned people?
Well, it turns out, and this is counterintuitive to some of the caricatures of Gen Z that a lot of folks, have in their heads. Gen Z cares a lot about fraud, about risk, and therefore about trust. This is why they actually like to see real people talking about real things without necessarily, having some kind of product to pitch or hawk or sell. It's because they want to do business and to have relationships and digital engagement with people and or entities and brands that they do trust. This absolutely goes to the issue of not just synthetic fraud, synthetic identity fraud, but application fraud and all of its different forms, et cetera, et cetera. And you're right, credit unions and just smaller institutions in general can't afford to take, X percentage of accepted identities behind new accounts opened going bad or proving to have or eventuating in fraud. They just can't tolerate that. Now, in the near term, there are lots of different ways. And by the way, AI is helping a whole lot in sniffing out synthetic identities in real time. And there are companies and all kinds of AI technology in play now fighting that fight and being fairly good and effective at it. The issue with both fraud and cyber risk, for that matter, in the digital context is a perennial one. And where we are now on that is basically, Robert, a few years ago, and I know you know this because you track this and kind of thing, we used to always talk about growth in fraud and cyber and all of those threat vectors in terms of breaches. How many breaches did we have this year versus last? And how many more records of information or data in these breaches went into, the dark web, et cetera, et cetera. We don't really talk that way anymore. In fact, breaches themselves in terms of absolute numbers have kind of flattened off in the last couple of years.
Or in another, a lot of times there are breaches, but they don't amount to anything.
Or they don't amount to anything. And this gets up.
No one discusses that. It used to be a breach was, oh my God, the dike's we're all gonna drown. But now it's like, well, right. Hold on. Yeah, it's this guy seemingly from China broke in, but he's not doing anything. So let's just chill out. Let's keep an eye on him, see what's going on here.
Yeah.
I mean, it's much more calm about that.
Where we are now and why there is a lot of legitimate and valid concern about growth in both fraud and cyber attack rates, but more so about fraud and cyber attack losses, is because there's no end of data on us all that's already out there on the dark web. That data is now being fed to very sophisticated AI tools by fraudsters so that now they don't have to cast as wide a net to do as much or much more actually damage in terms of losses, because they can now hyper personalize different forms of fraud attacks on individual consumers and businesses, for that matter, and scale that at almost no cost. So they don't need a whole lot more data. In fact, often they don't need any more data. There's plenty of it in the dark web to be had. It's that the tool set that can do damage with that same set of data has now grown much more sophisticated and much more cheap. So this cat and mouse game that is perennial in this segment. But in terms of how it gets back to Gen Z, they do care about this quite a lot. They might not necessarily think, as you said, it's not top of mind for them to think, wait a minute, is my money federally insured here, but not over there? But that's something that credit unions and other financial institutions have to be making a big deal of. I mean, they have to market that. They have to message that. They have to make that conspicuous. And they have to, instead of saying, hey, your stuff is federally insured here, they just got to break that down into, hey, your money is safe here. Whereas if you're, with a non-chartered XYZ app over here, you don't have the protections that we as a credit union can offer you. They do care very much about that, but you've got to talk about it in language that makes sense to them and does resonate rather with their concern in and around risk. Just like small financial institutions, like credit unions can't take, X amount of synthetic identity fraud happening in their new account opening process. Gen Z, most Gen Z they're not necessarily a lot of high earners, or they're relatively new in their career path. They can't afford necessarily to take a hit. 70% of the American population can't afford a problem with their money, a $400 or even $500 problem or balance that's off, or any kind of fraud on a couple of transactions, because they're literally living paycheck to paycheck. So these things that may seem small, depending on where you sit, are actually not. And in most cases, the psychology is one of sort of fear and loathing. And anytime anything goes wrong with a balance it's lower than what you expected it to be, that feels to Gen Z, and especially younger generations, and to those that are, well, actually most of the American population, it feels catastrophic. So if you can address that and message for that aggressively as a part of getting Gen Z to the door, you're much more likely to be successful getting them there, and they're going to feel much better about being there, knowing that they have that protection and there is that layer of trust there. And by the way, I think this is also what is driving a lot of these applications by fintechs and now by crypto companies to secure their national trust charters. It's not just that they want to get a cheaper, more direct access to FedWire and FedNow at the Fed through these skinny payment accounts that were now being talked about and that the Fed released an RFI on. They also like the fact that being able to say, hey, we're a national trust bank, or we've got that word or that verbiage as a part of our identity, now gives us an air of legitimacy and trust that otherwise we don't have. And so they know that. That's part of what's driving this rash of applications we see piling up at the OCC.
Funny, 20 plus years ago, I remember a very, very senior guy at PayPal. I asked him, will you ever get a bank charter? And he said, never in the US. At that point, they were apparently, I think they might have already gotten one in Europe.
Yes, that's right.
But and he acknowledged that, but he said never going to happen in the US. So apparently they've changed their mind. I doubt he's still with the company. This was a long time ago.
Yeah.
It's
They have changed their mind. Yeah, the wind has shifted in a big way, not just for PayPal. The OCC, just at the end of December, they conditionally approved 5 crypto companies for national trust charters. And the full service banking license that Erebor, the Peter Thiel affiliated digital bank, digital/crypto bank, they put their application in July and got it conditionally approved 4 months later. As you know, Robert, these things usually take years, 1 to 3 years to get any kind of approval of. And so now the OCC, they're handing these things out like candy. And this is a material competitive threat. The Genius Act has opened up. This is another thing that credit unions, I think it's just beginning to really dawn on them. But the Genius Act has diluted the value of the charter. It's lowered the protective moat of that charter. And over that lowered moat is coming this cohort of crypto concerns that want to establish a foothold and get to network effects before the time is up on the Trump administration. So we won't go down that rabbit hole unless you want to, but anyway.
Well,
yeah.
I will say I have more losses percentage-wise on Bitcoin recently than I've ever had on anything else in my life.
Right. Yeah. Yeah. I hear you.
I mean, now, then again, just a few months ago, I would look and gloat and say, hey, I'm up 200%.
Right.
And I was. And I was like, wow, man, I must be the smartest guy in the world. Well, apparently I'm not the stupidest guy in the world.
Well, just give it 6 more months, Robert.
It's no big deal. It's
right. You might be the smartest guy in the world again.
I find it kind of amusing that, there was a time when I was just gloating, but
right.
Now I dread to even look at the damn thing.
Right. Right.
So, end of the day, is there a future for the community bank and for the credit union vis-a-vis these smarter fintechs and a handful of mega banks, e.g., JP Morgan Chase? I mean, I don't have a number, but my guess is JP Morgan Chase employs more really competent AI people than the entire credit union industry does, all of them put together. Because I think the JP Morgan's Chase historically is when they're facing a problem, like how do we create a mobile banking app? They go out and hire the best people they can find, and it don't matter what it costs. There's the money
Right.
just is pouring out. I talked to the guy who coordinated their first mobile banking app, and what he suggested to me was that he had unlimited resources to hire.
Yeah.
It's
Yeah.
it was more a time frame. We got to get this done. It can't have big holes in it. It can't be crappy. Let's get it done. It's prices. Okay, you need money. Here it is. And I think JP Morgan and a few other of those guys are doing the same thing right now with AI. And
Yes.
so how do you compete? I mean, I don't know exactly how to compete.
Yeah. Well,
They're hiring really smart people, paying them a lot of money, and they want results for their money.
right. And the AI issue cuts both ways. So, you can look at AI is also a leveler. And if you look at the cloud wars being fought between the major public cloud providers, AI tooling, large language models, all of that stuff have by and large been loss leaders used to try to attract entities like credit unions and others to park their data in that respective public cloud. And now if we can talk about vibe coding, and we can talk about power of agents. Let me say one thing on that. This is also coming up at the top of a lot of top of year surveys in terms of things that matter, trends that matter for 2026. And so we're at the very beginning of the decade of agents. This is, some people are calling 2026, going to be the year of agents. More and more is going to be done with agents, but we're still at the infancy stage, technically, of what agents can and are doing. There are significant technological challenges and hurdles that have to be cleared with them. And by the way, this is not my opinion. This is Andrei Karpathy, who is considered sort of the godfather of software 2.0, agents, all the rest of it. But my point there is that, so if we're looking at more of a 5 to 10 year frame in which, the members of the credit union itself will be using agents in the back office. They may even be using agents at some point, or more directly exposing agents to the credit union members. But then the credit union members they can use agents completely independent of the credit union. And so there's a bigger structural issue in the long frame of what happens when and if the member begins trusting their third-party agent more than they do any direct relationship with a financial service provider, including their credit union. So, the people helping people movement, if suddenly it's no longer people helping people, it's agents helping people decide, and act on which financial product or service serves them best and next. That, in the long frame, is a more existential issue to the relationship-based model of financial services in the United States, including and especially the credit union movement of people helping people. To answer your question, I don't see it as a resource problem, Robert. I see it more as who wins the data wars, who can plug data deficits on members, because this is the other really, really big sleeper issue that credit unions are awakening to. And they're awakening to it actually much quicker than banks are, because credit unions have been leaning in and continue to lean in more on AI for purposes of efficiency gains relative to banks. But when you start realizing, oh my gosh, there's all these AI tools and they're not that expensive, but we're hyper regulated, and we want to do these really fancy, compelling things that are value adds that will bring additional value to the member, and we can capture and monetize that to some extent. But oh my goodness, we don't have enough data on our own members to do some of these most compelling use cases. And then they wake up to the fact that they only have 20 to 25% of their average members' financial data on hand at the credit union. And then this quickly gets us into a conversation. Well, how do you plug those data deficits on members? Because by the way, you don't really know your members if you only know 20 to 25% of what they're doing with their money that happens to be what they're doing with the one or two or three accounts they may have with you at the credit union. This is what gets us into conversations about open banking, the personal financial data rights rule, which, by the way, we learned only 3 weeks ago. A judge is forcing Russ Vogt and the CFPB to accept another tranche of funding from the Fed that will keep the CFPB alive through the end of March. And with that runway, the CFPB said, okay, we'll take the revision of the personal financial data rights rule through the full rulemaking process. And that rule, by the way, or the final version of it, whatever it is, will be the groundwork for how all this financial data gets exchanged and on what terms between credit unions and banks and fintechs. A lot of credit unions will see this as a signal to go kind of just, well, okay, we won't, because this is up in the air and there's so much chaos in the regulatory apparatus from the Trump administration. We just don't have to think about that. No. The most aggressive players, including Chase and including the big fintechs and including the most progressive credit unions and banks, are all looking at this regulatory chaos as a window in which to lean in and go on offense in terms of intentionally and aggressively asking members for permission to aggregate data from third-party relationships they have back to credit union. So the credit union has a preponderance of the member's data, actually knows the member for real now, and can use that data to create all manner of new value, products, services, solutions, you name it. And that is the end game. But if you don't see that and you're taking the regulatory chaos as an excuse to lean back and to just sit on your hands and wait for something to happen, I think that's a terribly dangerous blind spot to be in for a lot of credit unions and other financial institutions as well.
I think that the future of credit unions is uncertain in my mind. The future of community banks, I think, is certain, and it's not good. It's
well, I understand your pessimism, right? Given everything that we're seeing, the pace of change, the success of big fintechs going and serving consumers directly, the new onslaught of crypto concerns lining up for their charters to disintermediate both the payment and deposit, and through deposits, the lending franchise, basically the entire charter value of the credit union. These are all, I agree with you, are really, really serious structural concerns, challenges, and headwinds for credit unions and community banks. But here, if you zoom all the way out, Robert, I'm going to go ahead and do you ever ask your guests to forecast or to make bets on what's going to happen?
Sure. I have no problems with gambling.
I'm going to give you a forecast. We won't put money on it, but I'm going to give you a forecast. My forecast is that the chaos in the federal regulatory apparatus, which has seen a massive pullback in scrutiny and supervision, and is also at the same time letting in a whole category of new players that have not demonstrated any kind of regulatory discipline or compliance rigor at scale, is going to eventuate in an incident or handful of incidents in which a lot of people get hurt at scale. And then there will be a reaction to that and a flight to quality and a flight to trust that credit unions and community banks, if they're setting themselves up correctly in the interim, will be ready to capitalize on when that turn happens inevitably. And I am saying it with a lot of assurance here. It is inevitable.
Well,
I have all of this change, this loosey-goosey, this kind of the CFPB, no federal regulatory agency is giving any scrutiny to any of the fintechs that are coming on so strong. Something bad is going to happen. Maybe a couple of many things bad is going to happen. That's going to drive, again, the pendulum will swing, flight to quality, flight to trust. That's where credit unions and community banks will come back in. This is a serious issue for our economy writ large.
Many people do believe that there will be a rise in credit union failures, if you will,
Yeah.
as the examinations become more infrequent, et cetera, et cetera.
Yeah.
For the most part, this is going to be smaller institutions failing. Will it do much damage? I don't know. It might do reputational damage to credit unions in general, which would be unfortunate. Does Navy Federal need to have an annual examination? Probably not.
Yeah.
I think it's a good idea, but probably they don't need it. But there's a lot of sub $100 million credit unions that probably need a monthly examination.
Yeah. And I think most of that eventuates just into to driving the year over year consolidation numbers that we continue to see in the smaller financial institutions.
Compliance is one of the biggest problems that triggers mergers. The other issue is technology, of course.
Yeah. And actually the answer to that is reg tech and AI and the application of that reg tech, which could fundamentally lower the unit economics and the cost of both launching and operating a credit union or a community bank for that matter. So if you take these trends that are converging and you forecast them forward, there are scenarios in which it's going to be easier, faster, and cheaper to run a credit union, to run a community bank for that matter, and be able to capitalize on flight to quality and flight to trust that I see as inevitable in the relatively short to midterm. But again, I not only believe in credit unions and believe in community financial institutions, I know that this really unique and diverse ecosystem of community financial institutions that so efficiently makes credit available, makes new small business startup and formation possible in the United States. When you aggregate that all together, that is what has created this juggernaut economy of the world. And if we let that ecosystem die, we will pay a pretty big price nationally for that on a global stage and global scale.
A real plus of community banks in particular is their willingness to do small business loans.
Correct.
If you and I start a small business and I say, hey, let's go down to Chase and see if we can borrow $100,000. The Chase will say, 100, that just put it on your credit card, will you? We're not going to do a $100,000 loan.
Right.
Whereas a community bank lives on that $100,000 loan.
Yeah. And that, by the way, that's where all the action is. This gets back to Gen Z. Gen Z is driving, the formation of 4 to 5 million new businesses, small businesses in the United States every year. The way, this is independent contract work, side hustles, gig workers, et cetera, et cetera, et cetera. And if you understand that there's a blurred identity among Gen Z, consumer and business owner or small business owner, what Ron Shevlin calls Bazoomers, you have to understand that that's already inside of your membership base. And if you understand that and what they need, that is to get paid easily. This is why we pioneered with, again, Move and Visa and MasterCard tap to local, so that a credit union using data inside of its core can approve a member in a few seconds to begin accepting payments on their phone. And because many of those members, especially the younger ones, need to do that because they are effectively taking payment for a side hustle or a small business concern. And that's the way Gen Z is rolling. And that's the intersection between the small business opportunity in the United States, which is nowhere near fully tapped, by the way, and this Gen Z cohort we've been talking about. So
yeah, most of the Uber drivers I see in Phoenix, either Gen Z or senior citizens. There's not a heck of a lot in the middle for some reason.
Correct. You're absolutely right.
And half of the seniors are doing it, they tell me, not so much for the money, but they enjoy it.
Yeah, it's conversation.
Instead of sitting at home watching Fox News, you're out there talking with people about the Patriots and the Seahawks, whatever.
Yeah.
Before we go, think hard about how you can help support this podcast so we can do more interviews with more thoughtful leaders in the credit union world. What we're trying to figure out here in these podcasts is what's next for credit unions. What can they do to really, really, really make a difference in the financial scene? Can't all be mega banks, can it? It's my hope it won't all be mega banks. It'll always be a place for credit unions. That's what we're discussing here. So figure out how you can help. Get in touch with me. This is rjmcgarvey@gmail.com. Robert McGarvey again. That's rjmcgarvey@gmail.com. Get in touch. We'll figure out a way that you can help. We need your support. We want your support. We thank you for your support. The CU 2.0 podcast.